Picture this. You enter a textbook short position because a standard 14-period RSI hits 70 for overbought. But within seconds, an algorithmic buying spree launches the pair 120 pips against you. Traditional moving averages and static oscillators are like looking in a rearview mirror. They calculate exactly where the price used to be, but they have absolutely zero awareness of where the actual liquidity is moving next. We are operating in the 2026 market reality. The high-volume hours, especially the London-New York session overlap, are almost completely dominated by high-frequency trading algorithms. Retail traders are still trying to map these markets using decades-old static parameters. Meanwhile, institutional algorithms are specifically designed to hunt down and absorb localized pockets of liquidity. In an algorithmic market, static indicators often transform retail entries into the exact liquidity institutional players need to fill their large-scale block orders. The first necessary upgrade is throwing out the traditional moving average entirely and replacing it with the volume-weighted average price, or VWAP. This chart shows a standard smooth moving average overlaying price action, but as it shifts into a VWAP line, you can see how VWAP aggressively steps toward large vertical volume clusters at the bottom. By anchoring the price directly to trading volume, VWAP establishes the true mathematical fair value for the daily session. Institutional players know exactly where this fair value sits. When prices stretch too far from the VWAP, they wait for it to snap back. Entering a long position up here is a fast track into a mean reversion trap. Attempting to day trade without integrating real-time volume data renders you completely blind to where the large players are accumulating their positions. A major trap retail traders fall into is indicator stacking, layering 3 different oscillators on a single chart. The problem is, they all suffer from the exact same lagging data source. This split pane chart demonstrates a better approach: indicator synergy. The top pane shows a hyper-responsive momentum tool, the stochastic RSI. But speed creates false signals, so we pair it with the bottom pane, the average directional index, or ADX, acting as a directional filter. Here is the strict operational rule. You only execute a stochastic RSI momentum signal if the ADX reads above 25, confirming the presence of an actual trend. If the ADX is flatlining below that threshold, the market is chopping sideways, and those momentum crosses are useless false signals. Even with the right indicators, using a default 14-period lookback setting is dangerous. Market volatility regimes shift drastically within a matter of hours, making that static number completely arbitrary. Modern systems solve this with machine learning. Tools like FXNX's NXAI utilize walk-forward optimization. They analyze the preceding 48 hours of price action to automatically adjust your lookback periods to match the current volatility. Rigid parameters are a liability. To maintain a durable statistical edge today, you need intelligent systems that actively adapt to the market's current speed. But perfectly calibrated indicators still fail if you fight the macroeconomic tide. We use the anchor chart method to align precise 5-minute execution decisions with higher timeframe momentum. A 5-minute chart shows only a fragment of the story. Without confirming the institutional bias on an hourly or 4-hour anchor chart, traders frequently find themselves caught in localized stop hunts that contradict the broader market direction. This brings us to dynamic risk management. To survive the erratic swings of high-frequency trading, you need the average true range, or ATR. Apply a 20-period ATR specifically to the 15-minute timeframe. This diagram illustrates how the ATR generates a dynamic noise buffer. A static stop loss is easily triggered by a random algorithmic WIT, but by calculating your stop with the ATR, you position your boundary safely outside the reach of that localized noise. This logic extends to your backtesting. Data from 10 years ago reflects a market with significantly lower algorithmic participation. For a strategy to be relevant today, it must prove its effectiveness against the specific volatility and high-frequency volumes seen in the last 2 quarters. Surviving the 2026 Forex market demands a total transition. You have to move away from reactive, static guessing and embrace adaptive, real-time calculation. It's time to upgrade your charting setup. Download the 2026 Adaptive Indicator template for MetaTrader 5 and CTrader, and open an NX1 account with FXNX. You'll get access to 0.0 pip spreads, ultra-fast execution, and institutional-grade NX AI tools.